Very good morning, ladies and gentlemen, and welcome to this webinar where we would be analyzing the provisions of the tax code as they have been laid down in the consultation paper, which was issued on 28th April. Very interestingly, the consultation paper came just a couple of days before the Ramadan break. We were indeed tempted to do a webinar before UAE was almost shut down for Ramadan, but we thought that would be too early. One of the things which we are very, very conscious as we start talking about the tax code is that we would like to present to you not merely what is written in the code, but probably give you some value-added analysis, tell you how does one view, what are the things which need to be done. After all, that's the whole purpose why the government has put the consultation paper. If you can go to the first slide. So just before I go in, a few housekeeping rules. If you face any technical difficulties, please post it and we will see that it is attended to. We have kept last 10 minutes of the webinar for question and answer. I think that's going to be very, very important because I am very sure that as we analyze the provisions, give you our comments, you will have a number of questions which are specific to your organization. We'll try and answer the generic questions at the webinar itself. Those of the questions which time does not permit us to answer right away, you can rest assured that we will reach out to you and we will respond to you individually on the questions that you have. The presentation which we are making to you will be shared with all the participants, so you don't need to sort of make copious notes of what is there on the slides. Let's move to the next slide. As I mentioned to you, over the next about 50 minutes, leaving the last 10 minutes aside for question and answer, we're going to do analysis of the consultation document. On almost each of the slides, you will see not just the provisions of the consultation document, but also our comments. And that's very, very important because the reason why the government has put out the consultation document is to invite comments, and to provide that comments is something which is very important for us, because if you believe that certain provisions need a modification or something more needs to happen, then this is the right time as we go ahead and provide those comments to the government. We're going to talk to you about what are the next steps, and as I said, we'll leave some time for question and answer. I must share with you that while I will provide you the broad outline of the consultation paper, my partner here on the call, Venkat, who's based out of UAE, is going to speak about the technical analysis of the various provisions. He has, of course, been supported by a fairly large team that we have out there, which deals with corporate tax, including but not limited to Jai Rajesh, Kapil, Rachna, etc. And so there's a whole team which has put this together, sort of done the analysis, and that analysis is what I'm going to present to you. Next slide. This is a slide with which, of course, all of you are familiar. It was on 31st January that we got the first introduction to the federal corporate tax, and then we had FAQs. The FAQs did provide a framework of what is likely to come about, but it did not have the provisions per se. We now have sort of a glimpse of the provisions on the consultation paper, which came on 28th of April. The timeline for providing comments is 19th May. Seems to be a little bit of a shrunk timelines, particularly given the fact that we had almost a week off on account of Ramadan, but we need to make most of the timeline that is given to us. We are looking that after the consultation, we are going to have the final law which will be put out. And then, of course, the law comes into effect for accounting years, which commence after 1st June 23. We are all familiar with that. We need to be acutely conscious of it as we go along. Next slide. So let me give you the broad outline of the public consultation document. First is that the key aspects of the corporate tax have been set out in the consultation document. It is virtually the whole of the act, without, of course, making it too technical, but really the entire act has been put out. And as I said, that feedback has been sought on the main features and implementation. The reason why the government has come out with a consultation paper rather than coming out with the act itself is A, to absorb the provisions, provide responses, but also equally to start planning, because while the act may take a few months to come into place, we need to start sort of looking at, and we are going to talk about what next and why do we need to do. I may mention that several of our clients have already started looking at the earlier FAQ, started looking at what do they need to do. So people have already started planning about it. One of the facets on the consultation document is that the government would like to ensure that the compliance cost is kept to the minimum. And I must say that as I look at the broad provisions, the provisions have been kept fairly simple, fairly straightforward. You are all familiar, for example, that there are no withholding tax compliance requirements, etc. So the provisions in that sense are fairly simple, and yet we have been asked to suggest as to what more can the government do in terms of keeping the compliant cost to the bare minimum. The timeline, of course, is 19th May, I mentioned earlier, and all of us, the stakeholders, business community is invited to make a presentation. We at Dhruva have put together a team. We already have sort of some comments, and hopefully as we lay down the provisions, interact with a number of our clients, we'll get some more inputs, and we are looking forward to making that presentation to the government on what do we believe are the key points they need to take into account so before the consultation document is converted into an act. Next slide. Again, broadly, if I look at what is constituted in the consultation document, we have the taxable person, very important, who is liable to tax. This should be sort of expected in any tax law. Who are residents, what is their basis of taxation? Who are non-residents, what is their basis of taxation? We're looking about calculation of taxable income, and we'll deal with it because there are issues around, for example, what expenditure is allowable, what expenditure is not allowable. A very, very important aspect of the consultation paper is the provision for groups. Those who are dealing with VAT will already be familiar that you are allowed to sort of put a group together. There is a voluntary provision for groups, which again is going to be very, very interesting. It provides certain planning opportunities. It provides certain areas where we need to be more careful about. Transfer pricing is going to be a very, very critical aspect of the law for a very simple reason that we are looking at dealings between related parties, which earlier was never an issue to consider, which will now become a very, very important aspect. The consultation paper keeps a few items open, and one of the items which it keeps open, does not talk about it, is the pillar 2 integration. There is a recognition that maybe a lot more work needs to be done. Remember that pillar 2 comes into effect from 1st January 23, unlike the CT, which is going to come into effect from accounting years after 1st June 23. So that integration is going to be very, very critical. And finally, the law provides about administration, how the law will be administered, what are the provisions for assessment, what are the provisions for appeal. So with that broad framework and a broad outline, can I now invite Venkat? Venkat, if you can go ahead and deal with the specific provisions of the consultation document.
Thank you, Dinesh. So I think given the contours as any income tax law, you would assume that the law defines who will be liable to tax, and they have defined that as, while commonly used as corporate tax, individuals carrying on a commercial activity would be liable to pay income tax. We have laid out, that the individuals for their business and commercial activities within the UAE, legal persons incorporated in the UAE will be liable, foreign persons controlled from the UAE and on their worldwide income, subject to credits which may be available for taxes paid abroad. Non-resident entities, I think they're talking about them from wherever they have a UAE source income or a permanent establishment within the UAE. What may not have come out very clearly, and that will be part of, I'm sure, a representation or a request for clarity made by most people, would be, they have said unlimited, there are unlimited tax partnerships, and therefore, since they will be treated as tax transparent, what happens to the partner status? And do you treat since you will tax the partners on the income, what happens to the partnership itself, Consequentially, what happens to a TRC if required, or anything else which may come in. Another thing which normally people talk about in a very free way, they say free zone entities. There is also a word used as offshore companies. And what is not coming out clearly, either in the FAQ or in the consultation document, is what is this offshore companies, how will they be dealt with? Now, it may be that it is a part of the free zone treatment, but some specific clarity, as to what is the difference, if any, between the two, right? And how do treaty benefits, if at all, pass through the entities, especially on the partnerships or partners? We are aware of this. Yeah, I'll go to the next one. There are some exempt persons. The government has said that, the non-commercial activities carried out by the government in its sovereign function will be exempt as expected. So therefore, there was this question of whether certain companies which provide, infrastructure services, should they be exempt or not? Should they, are they covered by that? So one would assume that they are talking about entities which are specifically exempted. There is also a provision to apply for the government if you believe you should be exempt, but that's more in the case of charities, etc. But basically, anything on the sovereign function may not be liable to tax. Similarly, I think they have talked about how the real estate funds and the REITs will be treated differently. Public and I think, as expected, public and regulated private social security, as we have written, security funds or retirement pension funds should be exempt from income tax. I will spend some time on this slide, and I think the big one which absorbs everybody in the UAE is because UAE has, as we historically know, grown because of the free zones, and there are Jebel Ali as well. It is famous. There are a number of free zones in Dubai, Abu Dhabi, and indeed all over the Emirates. So while the business has been set up in the free zones, there is also the mainland, businesses which happen, and there are multiple, intertwining between the two. There are entrepreneurs who have set up very differently, whether it is a local businessman, entrepreneur, or a person who has come in from abroad. There were earlier partnership restrictions. You had to have a local partner. Then there were visa regimes. There were multiple business considerations which encouraged people to either go to a free zone or to come to a mainland. And it was usually a mix and match of both and different ways. So without getting into why each business went where and what happened and are there complications, at least the government has now said that they will respect the free zone benefits which they have given. Obviously, they don't want to impact in any way the business friendliness of the UAE. So therefore, what they are saying is, we will give you this 0% rate, which you will have in the free zone. That will be respected. But it comes with certain conditions. And what they are saying is, we will give you exemptions if you're doing business outside the UAE, but you're set up in that. So that's where I talk on the top left of qualifying income streams. Businesses outside UAE, incomes coming in, no problem, because you're in the free zone. Trading with other free zone entities, again, not an issue, because that's where you are all in the free zone. Then the regulated markets. Of course, they will, and I'm going towards the right, where we are saying conditions for the 0% tax rate. They would check the substance. It should not be a entity which has got no substance, or it is just set up as a one-man show or whatever. They will require audited statements. They will go into the verification of the sum and substance of how it was set up. You will have to prove that aspect. So you come into the free zone, you're dealing with outside UAE, you're dealing with other free zone entities, you've also got substance. There should be no issue on 0% tax. Now, the issue which starts is what happens when the free zone entity is dealing with the mainland, and which is likely to be very common. Commonly, we are talking about when you talk about, you say a free zone cannot trade in the mainland. That is the common understanding. But here they have brought in an issue of, you can set up a branch, a free zone entity can set up a branch, and that branch, which is in the mainland, does business, and it may be governed by a 9% tax rate. Again, if a free zone entity is getting a 0%, a passive income from the mainland, then also it should be a 0%, because it's a dividend royalty or payment which is of a passive nature. The transactions with related entities, they are saying will not get taxed, will remain at zero, while there may be a issue of deductibility in the hands of the mainland related party paying through. The sale of goods to designated free zones, then the importer on record, which will be the other qualifying activities where who is the importer on record and whether the goods are being sold by the free zone to the mainland entity. What could be disqualifications? I think one is they are saying you can, as a company in a free zone, opt for irrevocable option by saying I will be governed by the 9% tax regime. I don't want the 0%. There is a little bit of complication which we will deal with in some way when we talk about the Pillar 2 guidelines, because when you choose this option, there is an impact on the Pillar 2 also, both ways, whether you choose or not for free zone companies, but that we will deal with separately. And earning any other mainland income which is not passive, that causes that could impact your free zone tax holiday. So free zones, as expected, 0%. Export, you're good. Dealing with other free zones, you're good. Passive incomes, you're good from mainland. But you're dealing with anything else which you are sourcing from the mainland, you could have an issue for yours 0%. And if it is to a related party, the related party could suffer a non-deduction of that. So in effect, your group will end up paying 9% tax at the related party level. We've got some illustrations to help what I spoke of, and it is we have tried to make it self-explanatory and you can see it. But basically, what we are saying is the facts are that in the box, FZ1 and FZ1 transacts with FZ2, both are in the free zone. It deals with the overseas company and it has a branch in the mainland. The question is, can free zone 1 be governed by the 0% tax regime? The answer seems to be yes. The free zone can take the benefit. However, the branch profits will be taxed at 9%. Free zone should not be an issue, and overseas is not brought in here. The next one. Here we are talking about, again, the facts are free zone 1 is selling goods or earning passive income from the mainland entity, which is a related party. And mainland 2, ML2, which you see, is not a related party. And what we are saying is that when both deal with them, whether it is passive or sale of income from sale of goods, free zone 1 would be eligible for a 0% tax rate. Payments by mainland 1 to free zone 1 will not be tax deductible. Payments from ML2, which is unrelated, a mainland entity, will be deductible for ML2. So ML2, unrelated party mainland, dealing with your free zone entity, no issues because they will get the tax break. But if your related party is dealing with your free zone entity, you could suffer a tax non-deduction in the hands of the mainland entity. So therefore, your taxable income will go up by that extent. Now, the law has used payments repeatedly. And there is an assumption that payments is not just payments. It is payments for goods. It's payments for all services. So therefore, one could not say that, oh, the law is saying payments, so it is pure payments, right? So we are assuming it is for payments for goods and services. Yep. How will you compute your incomes once you are talking about, you are governed by the regime? Where do you start from? There, it is categorical that it is the accounting profits and loss which will be used. There will be an acceptable accounting standards as a starting point. Normally, you would expect everybody to be governed by IFRS, and IFRS accounting would be the starting point. If you, however, say that you are not governed by IFRS or you are not adopting, then it would have to be a reasonably acceptable accounting standards. And so therefore it would be international accounting standards of, some companies or entities may choose to do that. You would also have to say unrealized gains and losses on revenue items will be included, but on capital items, they will not be included. So therefore, you have an accounting profit. That's your profit, which starts, your results start. Unrealized gains or losses on capital account will be excluded, but on revenue account will be taken. Incomes exempt from tax. So dividends from UAE entities, we talked about it. We talked about it, earlier, that within the UAE, that passive income concept is not being taxed because you've borne the tax once. And again, if it is within the free zone to free zone, again, it doesn't matter. Foreign dividend, any capital gains exempt subject to conditions of qualifying investments, 5% holding, etc. And once you qualify, there are conditions, and then you should be able to get the benefit. Foreign branch profits, we are saying it is exempt, and you will claim that exemption. Alternatively, you will take the tax credit for taxes paid in the overseas country. Now, typically, you should not expect that if you have paid a tax higher than the UAE tax rate of 9%, that there is anything more to be done in UAE in terms of a refund, but you will still consolidate, file those returns, and then you will say excess tax paid, your credit is likely to be limited to the 9% or your liability. As expected, the aircraft and leasing are governed by the treaties, and they are kept out of the ambit of this. Share of profits, I think the question which we are asking, or rather the comment which we have, is share of profits from other entities like LLPs, etc., are taxable. And so therefore, once you are taxing the individuals, how does that play? The LLP or the partnerships may not be filing the tax return, but you will tax the individuals and compute your taxes accordingly. That's something which we assume that once the final law is there, based on how the transparent entities are treated, we will get clarity on this. Yes. If I may say so, or many of us, we are seeing this flavor coming in already in the first draft about certain checks and balances coming in. And before I get into each of these, which all of us would have read and understood and have our own view, I think somewhere the government or the federal tax authority is also trying to, say the preponderance of shifting equity to debt or debt to equity, they are bringing it in some kind of a deduction for interest deduction. Without putting in very elaborate thoughts on interest deduction, they have basically said it will be up to 30% before your earnings EBITDA. So that is the limitation which they have given. They are saying to a related party, it should be only for commercial reasons. And I think, the first answer which one may say is that any loan ought to be for commercial reasons. But I think what they're saying is you can't load up a debt in the balance sheet just before this law, try to claim it as a deduction because it's a related party, etc. So there will be some amount of scrutiny or some amount of looking at the debts raised and who is raising the debt, for what purpose it is used, and of course there is a cap on the deduction of interest. Entertainment expenses, very interestingly, they say all entertainment expenses, the deduction is limited to 50%. So simply stated, you spend 100,000, you will get a deduction of 50,000. Obvious questions which come up in the mind is, what is entertainment? Yes, we all understand entertainment in a general sense is, maybe, having your clients and your customers out for, an event or a dinner, and there's a business meeting followed up by a dinner. Up to what extent do you go, and how far do you go? But this is a tourist country. There is entertainment done, but we are saying that there will be a 50% deduction or a non-deduction. So therefore, this is something which I think will get debated and discussed at some point for people who have a huge spend on this. As expected in many other jurisdictions, many other countries, anything which is a penalty is never tax deductible. So if you paid a penalty or a fine for a contravention of law, you shouldn't expect a tax deduction. The recoverable VAT, not tax deductible, I think what they're saying is, if you are saying that the VAT is something which you are going to claim as a refund, or you have shown it as an asset and you are planning to claim it from the VAT authorities, that should not be an expense which you should write off. Related party payments made to a free zone entity taxed at 0% are not tax deductible. Now, this is the big one where I think people have to be concerned, and this payment would be payments of all kinds. So if mainland entity is paying to the free zone entity, it's a related party. As we read it today, we are saying that you will not get a deduction for your expense. So you can go ahead and do your business, you can do your transaction, but it will not be tax deductible. And so therefore, you have to watch for, how you're structured, what payments will go through in your system, and how you will handle that. Yeah. Donations to unapproved charitable and benefit organizations are not tax deductible. So I think what we are saying is that donations have to be through approved charities. There is a procedure laid out as to what charities will get approved and who will be the person approving them. And eventually, donations to any of the others may not be tax deductible. Yes, as we have it on the comment side, the provision for carry forward. I think it's not very clear as to how long will you get a carry forward. It seems to be that there will be no carry forward, meaning once disallowed at that cap of 30%, then the excess which you could not claim as a deduction will not be allowed to deduct in the future years, because in the future years you may not have hit that threshold. There seems to be some anomaly there. Maybe it is required to allow you to set it off cumulatively over a period of time, because elsewhere they have said losses can be carried forward without a timeline restriction, with subject to other conditions of reorganization. So maybe this is something which needs to be helped out a little bit. Now, tax losses and groupings. Now, losses can be carried forward, and that's a welcome step where they're saying that if there is losses, they're not prescribing a time limit. So what they're essentially saying is you can carry forward till you can set off those losses, and to that extent, it's a welcome thing. What they are also saying is the set off is permissible only up to 75%. I think we have seen this similar law in the GCC area. We have seen it in other jurisdictions, other countries. So basically up to 75% of your profit. So if you are in a loss and in the future year you're in a profit, you should expect to pay 9% tax on the 25% of the balance profit. So there is no escape from no tax once you hit that profit period. But of course, you will carry forward the others, which is not set off. In case of change of ownership, and this is very common in many countries, in case of change of ownership by more than 50%, tax loss may be carried forward. They are specifically brought it out here that they're saying that if the tax loss can be carried forward by the same or similar businesses carried on by the new owners. So if the new owners, 50% of the tax losses can be carried forward as long as they continue the business. The thing to note about is that, and I think it came out in the FAQ also, the losses incurred before the effective date of the corporate tax are not available for set off. i.e., one should assume that any losses before the accounting year, or rather after the accounting year starts for which CT corporate tax is applicable, any losses prior to that, you will not claim a set off subsequently. So that's something which you have to just keep aside once the corporate tax comes in. Tax groupings, I think while there is some clarity required as to is it automatic, am I forced to do it, am I choice? What we seem to be interpreting today is that companies having a common shareholding of at least 95% can form a corporate tax group. Dinesh talked about people being used in the region, in the Emirates, about the VAT groupings. Here we are talking about a common 95% shareholding. There are a couple of clients who have asked us that even if we have a 95%, do we have to group? And the answer seems to be, it doesn't seem to be that yes, you have to automatically group, although you may choose to do that if you meet that 95% condition. Transfer of losses between group companies with a minimum 95% is possible. So you may want to again group if you have that 95%, at least common ownership is permissible, you can transfer. So even if you're not a group in that sense of grouping earlier, but if you have a common shareholding of up to 75%, then you may be able to transfer the group losses incurred in one entity to the other entity. I'm sure the forms, the rules, and the mechanics of how you will transfer, how you will record, how you will claim will come out, and that is how you will follow that process. I think another one is within the group companies, when you transfer assets and liabilities, they are not subject to tax as long as you hold that. I think they have also talked about, and this is a nice welcome step upfront early to see that business transfers, corporate restructurings, mergers, spin-offs, which may become, as time goes by, this is something which will keep happening. Once they are in exchange of shares, they are to be exempt ownership. So we are used to, words of tax neutral mergers and, amalgamations happening. And that's a welcome step to say corporate restructurings, there will be a tax neutrality to it. I think, as we have said on the comments, some of the words need to be defined for everybody to understand. One hopes that that will happen once the law is enacted. The time period, again, while we have said no time limit for the losses to be carried forward, time limit for a business which needs to be continued for a new owner. So once a new owner comes in, you have said 50%, more than 50% of the ownership changes, they can set off the losses, but for how long do they need to continue? Can they just start it for 1 year and then they drop it? Yeah. I think briefly, Dinesh touched upon the aspect of withholding tax, etc. But let's just take a minute to understand, minute or couple to understand what we're talking about here. We are saying that there is no withholding tax as such, right? Many of us understand when there is no withholding tax, it is not subject to tax, etc. But keeping aside those interpretations which we may have picked up from elsewhere, the law says there will be a 0% rate for certain withholding tax, for certain payments cross-border, which means they have identified that these could in the future be subject to a withholding tax of a higher percentage than 0. And if you look at treaties or other jurisdictions, you always hit up 5%, 10% for different things. There are interest, dividends, royalties, many things which are subject to withholding tax. And there could be group payments, there could be shared service costs, there could be, the intercompany management costs which are coming in. Right now, we are talking about all these are at 0%. But this is a space which I think all of us following the UAE tax regime, I think we will see this developing increasingly because in a year or two, once we get used to corporate tax, we have seen it in GCC, we have seen it in other jurisdictions, withholding tax will increase or will come in, that is the expectation, but they're setting the tone for it. Today, yes, 1 June 23, new law, no withholding tax, 0%, no compliance, ease of compliance is taken care of because there's no withholding tax to do. But very happily, they have said that if you have paid taxes in a foreign jurisdiction, you will get credit in the UAE. So withholding tax in any other country, which maybe earlier was a cost to you in the system, because UAE was a tax-free country, was a tax-free emirate. So you never had an ability to set it off. But today you at least can set it off against your 9% liability if you have paid a withholding tax elsewhere or a foreign tax has been suffered earlier in the branch, etc. From an administration point of view, we are talking about every taxpayer needs to get themselves registered. There will be a 9-month period by which you will file your annual tax return and your taxes. So no advance tax or no tax as the year is going by or any other period. So if I use the calendar year, if I say January to December is my calendar year, at the end of December, I get my accounts audited after my December year ending is over within 9 months. So which means 30th September. So if I roll forward to 1st June 23 after 1st June 23, let's say my first year is calendar year of 24, Jan 24 to December 24. My year is done on December 24. September 25 would be my first tax return and my tax payments. And that's when I have to comply with all this. Of course, you can work the 9 months if your year ending is different. There are very few lines on this in the consultation document, but they are saying that a CT return will be subject to an assessment, and you may challenge that assessment if it is not in line with the tax return which you have filed. They have provided for the FTA will provide private clarifications. So we commonly use the word advance ruling. We commonly use, and in the VAT regime in the UAE, there is a process called clarification. So which means this taxpayer can apply to the FTA on a particular tax issue, ask for a clarification, which is binding on the FTA and for the company. It may not be something today which they are envisaging as the whole universe can use that. Maybe that's in the future, but today a taxpayer, instead of worrying about and getting into a litigation or getting into a period of suspense as to how the FTA would view this, there is a process already set up that you could ask for a private clarification. On pillar 2, I think on pillar 2, without getting into all aspects of the OECD, developments, etc., what do we know so far? We know that at 1st Jan 23 is the date when we are talking about the pillar 2 will be applicable for all the signatories. There are about, I think, 136 or 138 signatories as of today, and that number changes. There is also a talk that the pillar 2 guidelines, pillar 2 implementation may change to a December 23 or some other year, right? Or some other period. But one or the common talk is that it may move from Jan 23 to December 23. But where we are today is Jan 23. So what happens if you are a MNE which is having a turnover of over 750 million euro? You are governed by the pillar 2 regime, and commonly pillar 2 talks about 15% tax rate. And so therefore, let's keep just 2-3 things. And I'm not wanting to get into all the technicalities of how a pillar 2 tax regime will be calculated. And there are different terms used and who's got the taxing rights. No, that is not this part about it. But for all MNEs in the UAE who have subsidiaries outside or who are held by a parent outside, this could somehow, it will impact them, especially if they are otherwise owned in the UAE and you have set up a holdco outside the UAE. And so therefore, it is important for us to understand that for a MNE, it may not be 0%, it may not be 9%, it could actually be 15%. And 15% is coming from the pillar 2. The difference between 9 and 15 or 0 and 15 is what would be the top-up tax, which the FTA has said they will do it in the consultation FAQ. In the consultation document, they are talking that this will be, as time goes, they will lay this out, and the pillar 2 is under discussion, and they will lay out what they propose on this. So if I step back, globally, we are saying the globe rules say 15%. UAE has got domestic tax rate at 0% and 9%. If I'm an MNE and I'm waiting for the guidelines to happen, I should expect that my overall income will get taxed at 15%. Now, apart from I am not an MNE or I choose not to be an MNE, I'm only in the UAE, etc. All those aside, what you're talking about is that your entire income, because of the way you are structured, and these are fact specific, and this cannot be an answer which I think any of the people who are in this practicing or advising in this field would be able to say a cookie cutter approach of saying this is the answer which will fit all, except to say that it is complex. It will take a deep facts finding exercise. You will have multiple thoughts on how your business will attract this tax. But that said, once you come into the conclusion, you could end up having a 15% liability. And I'm assuming that the top-up tax is the same gap between 0 and 15 or 9 and 15. And so therefore, pillar 2 and what is happening in that space will impact UAE MNEs. And that is something which should not be forgotten. Similarly, they have also said that for entities outside, if the place of effective management is then those entities could be brought in, right? So one has to be watchful of if there is a family or a business house which is running a business entirely outside, but they're all sitting in the UAE and managing it. How does that impact given these regimes when this kicks in? So if you're a pure domestic, free zone, 0%. If you're a domestic mainland, 9%. Cross between mainland and free zone, case specific, but you could end up losing either the 0% benefit in the free zone, or you could end up losing the deduction of 9% for payments in the mainland. Apart from those, now you switch to the next, what should I say, the piece which you will have to deal with is if you are a MNE, then what happens when the Pillar 2 kicks in? And does that change your structure? So for some entities, this may not be about just planning for June 23 and after. It may be about looking at the entire structure, which may go beyond what they're talking because of this integration. But like I said, we want to talk about the consultation document and what it does. But this is something which will have an impact on people who are governed by these provisions. I think on the transfer pricing, I think it's very natural to expect that, when you have all these between free zone, non-free zone, and when you have the impacts talking between related parties, you will have transfer pricing applicable. There will be provisions on how you should declare that, how you should maintain the files and documentation, and how you would submit that documentation in your tax returns. So 50% threshold is what they have kept for shareholding, and that's how this information will go in. But I think for many companies which have already started complying with the ESR regime, or they have talked about how they have dealt with their documentation on CBCR, etc., this would not be totally new. But otherwise, I think there will be domestic companies which will start looking at all this when they're talking about free zone to non-free zone. With this, I request maybe Dinesh to come back on these slides as to saying what are the next steps and what we should do on this. Dinesh?
Thank you, Venkat, for that explanation and taking us through the provisions. I think key things. First, I mentioned earlier on, and I think this is most important, is that we use the time between now and May 19, which is just about a working week, effectively to make a representation. I think it's very, very important that on issues which confront us, where we need clarity, we ask for clarifications, so that the law, when it comes out, takes into account a number of things. Venkat, for example, mentioned earlier on that when we are computing taxable income, revaluations on current account are not to be taken into account. Are to be taken into account. Revaluations on account of capital account don't need to be taken into account. Now, that's a very, very important provision. And that was a concern which many of the taxpayers had, that if you have made a long-term investment, values have gone up, I have recognized that, I have not realized it, am I required to pay tax on it? Not required to pay tax on it. Similarly, there will be several other issues, again, dealings between free trade zone, outside free trade zone, number of things which need clarification, and it's important to make those representations so that when the final law comes out, our representations have been taken into account. Venkat earlier mentioned about MNCs and Pillar 2. Those provisions are still not there in the consultation document, and we need to ensure that when they come up, those are something which we have factored into account. We need to be very clear in our mind. We need to be aware and alive to the fact that if we are an MNC, which is companies which turnover of more than 750 million euro, operating in more than one country, then we will be impacted by BEPS provisions, Pillar 2 provisions, and while we await the interplay under UAE domestic law, but we just need to be very, very conscious of it. We spoke about free zone, and I think that's going to be a very, very critical aspect, because several entities have got presence both in free zone and in the mainland. And I think the issue really which comes in is that if there is a payment by a mainland entity to free zone entity, that's disallowed. Is there a double disallowance there? How does one deal with it? Again, there are things which are a little bit open out there in sort of realms of gray, and we need to find answers to that. We need to start working about our TP policies. That's going to be very, very important. We need to be conscious of related party transactions. In fact, one of the things which, of course, is going to happen is that as we restructure our operations in preparation for the corporate tax law, we're going to have probably far more related party transactions than we ever had. So if, for example, we have IP allocated in one jurisdiction, payments made for that, those will be related party transactions. What sort of documentation do we need to do to ensure that these are arm's length? And while we wait for the law to provide clarity, we need to have something which from an accounting standpoint is going to stand the test of time. We've got to look at our accounting policies. If our accounting policies, for example, do not confirm or are recognizing revenues before they accrue, or not recognize expenses in a particular manner, we need to just ensure that how do our accounting policies tie in with acceptable accounting standards, so that when the law comes in, we are not sort of faltering on those things. We spoke earlier about groups. And I think as we go along, groups is going to be a very, very critical aspect. We'll need to make choices. We'll need to do a number of things in and around groups, etc. Are our ERP systems ready at this point of time? Mercifully, we don't need to do withholding of taxes, etc., etc. But is our ERP system ready such that at the end of the year, when we need to compute our taxable income, we know what's going to happen there? We have seen some of the larger groups already getting ready. We have seen working with some of these larger groups how they started relooking at their operations, restructuring their operations. We need to be alive to the fact that while 1st June 23 and our accounting year, which commences after that, is some time away, it's not a long time away. Any accounting policies, any changes that we make closer to the tax law coming into force could potentially be viewed as something which is being done only for taxes. And that's not what we want to do it. If we are making certain changes in the structure, they need to have a commercial rationale. They need to be sort of standing the test of time. And therefore, the sooner we act, the better we are. As I mentioned, some of the more progressive corporate groups, some of the larger tax houses, larger corporate houses have already started relooking at themselves. And I would encourage everybody who is on this call not to really wait for the last moment for the law to come into force to look at many of these aspects. And that's going to be very, very critical. And I'm very sure that if there is one key takeaway which I would like to leave with you as we go along, is please relook at your structure right away. Please relook at your accounting policies. Please look at your ERP systems, related party transactions, so that when the law comes, you are absolutely prepared to sort of ensure that the taxes that you are paying are optimal and are not needless. So with that, really, we have about 10-12 minutes to go, and we are going to talk about the questions which have come. We have got several questions, about 16 odd questions which have been put up, and we'll try and answer them. And obviously, one thing I must put as a caveat as we respond to the questions, and even as you look at our presentation, that we are dealing with a consultation paper. This is not the final law. As we make representations and the final law comes, the provisions could undergo a change. And we need to be conscious that whatever response we are giving to you at this point of time is on the basis of what we see in the consultation document, which may not necessarily be fully sort of thought through in its entirety as has been proposed by the government. So our responses are tentative to that extent. So let's go. Venkat, would you like to go to and talk about some of these, and I can pitch in for some of them?
Yes, please. I'll just take. So there is a common thread on the free zone part. I'll just take some of those questions. And I'm the people attending this need to pardon me a little bit, because after my presentation, I'm just trying to look at the questions and the answers, what the answers are. But I will do my best. It'll work. So one of the questions is the revenue earned, and I'm reading literally the question, is the revenue earned only on the land of UAE will come under the purview of corporate tax? I think there is another related question which says, does Dubai Media City zone can be treated as a free zone for the purpose of corporate income tax? I think broad says, so a resident would be liable for the worldwide income. A resident would be liable. And what would happen is that the credit paid in the foreign countries or the foreign jurisdiction will come in for credit. So you have incomes anywhere. If you are bound by the tax of the global income here, you will get the credit for that. But let's
So if I
read
could
that.
just come in, Venkat, for a moment there. So again, consistent with provisions all across the globe.
Yes.
If you are a resident in a particular country, then you pay taxes on your global income. Two things happen. If for any reason, any part of the foreign income is not taxable, then obviously you are not entitled to the foreign tax credit which has been paid there. And whenever you consolidate the entire income, the taxes paid in that jurisdiction is available to you as a set-off to the extent that you have to pay taxes on such income in UAE. So for example, if you are an MNC, and the presumption is that the rate applicable to an MNC, qualifying MNC, is 15%. If you have earned income overseas, that income becomes taxable in the UAE. You will get credit for the foreign taxes, but limited to 15%. So so foreign income taxable in UAE, it's not merely the income earned in the land of the UAE, global income liable to tax. However, you get credit there so that to that extent, you don't end up paying double tax. Yeah.
Yeah, thanks for that, Dinesh. Another question is, does Dubai Media City Zone be treated as a free zone company for the purpose of a tax? And I think the answer is yes. If it is a free zone, as long as you comply with the free zone regulations, and it should be governed by the 0% tax rate. There is one more which says, which services are covered under the regulated financial services? I think here we have an answer as to saying, and I'm reading from the consultation document, I think we are talking about banks, finance companies, and insurance companies, which should be governed by the regulations of financial services, right? If a free zone entity, another one, if a free zone entity sells, this is what question number 6, right? If a free zone entity sells to an entity on the mainland which is importer on record, will the free zone entity be entitled to 0% tax? Yes. If it is selling, it should be allowed to maintain its 0% tax rate. So that should not be an issue.
Let me come in, Venkat. We have a very interesting question as to what would be the cutoff time for any organizational restructure, especially if you are an MNE. I'm presuming that Mr. Srinivas Yanduri, who has asked this question, really is sort of wanting to know that if, for example, you are crossing the threshold of 750 million euro and you want to sort of come down below that, or you want not to be classified as a multinational enterprise, then by when should you be doing that? And I don't think the law really provides that answer. The answer really is that if in the year that you are operating, your turnover is more than 750 million euro, or you are operating in more countries than UAE, then you'll be classified as an MNE. And if you want to restructure yourself, shed some of the, and we have seen people wanting to do that. So we have seen situations where people will want to say, here are operations which maybe don't add value to us and we would like to shed them. If you need to do that, you should do that sooner rather than later, but certainly much before your accounting year commences, so that you don't fall foul of the new provisions. There is then a set of questions which deals with is provision for doubtful debts allowable. I think those are the items on which answers are not available today. Clearly, when you begin your taxable income using the profit as per profit and loss account as a basis, and if you have provided for doubtful debts, then they will be allowed as a reduction. The question would be really that, are these debts really doubtful? So long as they are reducing your accounting profits, those would be logically allowed as a reduction. But I'm very sure that when the law gets finalized, we'll have some more provisions. Yeah, Venkat.
Yes. So I think just reading on from there, there is a couple of just reading on from there, there is a couple of questions which says, would it be better to have standalone FS financial statements for free zone entities? I think first you will have a legal entity-wise financials audit as applicable, and free zone entities are likely to be audited. I think the question, if I may suggest, is asking whether the free zone entity is better filing off a corporate tax return separately or rather as a group, because once they get mixed up. I think the tax grouping is a separate discussion, and there may be a facts which will require a group to say, I don't mind consolidating my free zone entity because I have opted to pay the regular tax on the free zone entity, or there are losses in the free zone entity and I don't mind it being set off against the gains of a non-free zone. So answer is you would decide separately on whether you want to group, but it would be separate financials anyway made for a free zone entity. And so that answer is yes, you would have a separate audited financials.
I have a very interesting question here that for transfer pricing, have they covered even the covered persons as related party? Any idea how to benchmark managerial payments? And again, there is no specific definition as yet. We are looking at a consultation paper rather than law. But I would be very surprised if in the final analysis, the provisions do not provide that payment between owner of a business and the business itself is subjected to transfer pricing regulations. As to how do you benchmark key managerial people payment? A very, very difficult question, but not impossible to answer. There will be, I'm very sure, as time goes by, payments which will be made by several entities which until now have not been remunerating the owners or the owner CEOs if they are working for the business. And I'm sure over a period of time, those databases will available as they evolve around the world. I think, yeah, maybe we have time for one more question, Venkat, and then we should wind up the. Yeah, Venkat.
One minute. Just hang on. Yes. So I think one question which, again, free zone, and since I saw the word JAFSA offshore company dealing by buying goods from outside UAE and selling outside UAE, there should be no issue because you are an offshore company. I assume you're saying free zone, dealing by buying goods from outside UAE and selling outside. So you're just an importer and an exporter. There should be no issue at all. Completely out of the tax net in the UAE. Again, depends on whether you're a part of a group and then other regulations kick in. But yes, you should be tax-free. As
I think that's about all the time that we have for questions and answers. Ladies and gentlemen, once again, thank you so much for attending this webinar. We were overwhelmed with the number of people who registered. We had almost 200 people participating at a peak point of time, and I hope that you found the comments that we gave to you value added. As I mentioned to you earlier on, we did not merely analyze the provisions of the law, but the idea was really to sort of tell you what are the items of concerns that you need to have and what you need to start factoring. Remember that this is a new law. Remember that the consultation paper will get formulated into act, and you can rest assured that when the law gets promulgated, we'll be once again engaging with you to tell you what are the provisions of the law. But it's just important to leave that last comment that we start looking at what is it that you need to do in terms of reorganization if it is needed. You need to start looking at your related party transactions, start looking at free zone, mainland entity transactions, etc. So that when the law comes in, you are very well set to comply with the provisions of the law. We enjoyed bringing this to you. We can assure you that all the questions that we have received, we will send out formal responses and we will circulate the presentation. Thank you once again. And with that, we close this webinar. Thank you.
Thank you. Have a good day. Thank you.